What if one chart pattern could actually reveal your next trade before it even finishes? What if one setup wasn't just a trade, but a clue to an even bigger move that was about to happen? In this week's Trading Edge, I'm going to show you exactly what I mean as we break down 11 of the top trading ideas on my radar for the week ahead, along with a warning of when I think that yen intervention is likely to come. Let's learn to trade. Here on the Aussie dollar, we are about halfway, about maybe a third way complete the final leg of an advanced pattern formation. This one's going to be called a Cipher pattern. But the cool thing about this is that it may also set up our next move. So let's start off with the Cipher here. Our starting point is going to be right here. This is going to be our initial swing high to swing low. We're going to call that our X to A leg. This first retracement is going to be our A to B. Now, what's different with the Cipher in comparison to other advanced patterns like the BAT and the Gartley, for example, is that instead of a failed extension, we actually get a full extension down here. That is going to be our B to C. And then for a decompletion, what I want to do is I want to take my Fibonacci retracement tool from the extreme high of that pattern to the extreme low of that pattern. And I want to look for a move back up to this 786 right here. So all in all, if I bring my tool on here, we have an X to A, swing high to swing low, A to B retracement, B to C extension, and then a C decompletion right up here at the 786. Which would be the starting point of our Cipher completion zone for a bearish trade. Now, what's interesting about this is that if we pop up one more time frame to the weekly, and we take a look at what the Aussie dollar is doing bigger picture, you can see, and I may need to delete some of this stuff just to give you a clearer view of it. You can see that we are also potentially putting in a classic reversal pattern in the form of a head and shoulders. So price action has been in an extended bullish move. We can start all the way down here if we want. We have put in a little bit of a retracement. We have put in a very shallow extension. We have put in a very deep retracement. And then what we would need to put in the next step of our head and shoulders would be a failed extension. So in a normal healthy trend, we would see price action extend further up and we'd have that new structure high and whatnot. In a head and shoulders pattern, what price action typically does is it extends, but only to the length of the previous shoulder, which is right over here. And then if it does end up being a head and shoulders pattern, we end up breaking our neckline down here. So if you notice something interesting about this setup, that Cipher pattern that we had on our radar, I'll put a little target here just to have some fun, is exactly at the symmetrical point, right? Look left, structure leaves clues, as our left shoulder. So this Cipher could actually end up being the right shoulder of a head and shoulders pattern. Now, does that mean that you should ignore the Cipher pattern, use this only as an entry reason for the bigger head and shoulders and hold everything to trade it down lower? No, it doesn't mean that at all, but you can. And if you're someone that uses higher time frame analysis, what I would suggest doing is this. Instead of just taking your Cipher pattern targets off at your normal target 1 and target 2, perhaps leave a portion of your position on, meaning that you have your Cipher right here, X to A to B, B to C, C to D. You trade it like a normal Cipher, but instead of taking everything off, maybe you leave a little bit of that position on just to see if you can catch that bigger head and shoulders move. Is there a chance that it may not work out? Yes, but there's also a chance that it does. And if that's the case, this would be a big move to have exposure to. I've got a lot to talk about here on the Euro New Zealand, so where to start? Let's start with reversal signs. You've heard me say before, the strongest reversal sign in the market is going to be something called a V reversal. And well, we've got 3 great examples of that right here, right? You can see price action rallied up and then we turned right around and came back down. We rallied down and then we turned right around and came back up. And then we turned right around and came back down. And then once we got to the bottom here again, we did that exact same thing. So we are currently in the beginning phases of a very strong reversal sign here on the Euro New Zealand. Something else that we have down here is my favorite reversal pattern called a 3-bar reversal, right? We have a bearish candle right here. We have a pin bar doji right here. The long tail to the downside shows us rejection. So what that means is that at one point, this was a bearish candle as price pushed down to this level. We ran into structure. The bears got defeated. The bulls pushed it up. And you can see the wick here is the last remains of the dying bears that tried to fight off that level. We then followed that up with a higher high, higher close candle right there, giving us confirmation of the bullish momentum. And then boom, we had a nice bullish candle off of that. So just really cool clues of the market that I want to share with you guys while I had the chance. Now for the opportunity. Because we are range bound, I do think there's certainly the opportunity that we can cross the entire range once again. But the first place I would expect us to go to is right around here. And although we made our way almost to that level, we haven't quite gotten there yet. And what you can see today is that price is retracing here. And as we go down to a lower time frame, this is going to be nothing more than a pullback that is going to offer another opportunity to get involved in that long. So let's go down to the 4-hour chart here. Let's erase some of my drawing so that you can actually see the chart. And you can see the pullback that is currently happening. Price is coming right back down to this area right here. I don't know if this is where price is going to stop. We're gonna have to wait and see for more price action clues. But what I would wait for as a pullback trader is for price to pull back. Look for our signs of potential reversal, whether that is an indicator that's being used, whether that is a price action pattern, like another 3-bar reversal, for example. Ooh, by the way, look at this, another beautiful one right here. Gorgeous. But look to catch that next move to the upside. Now, real quick, the other day I put out a video on the RSI and different ways to use the RSI. And one of those ways was reversal and looking for a head and shoulders. Well, what do we have here? As you look at when price action rallied up and we kind of just started moseying on to the right before reversing back down, what did we have here on the RSI? We had a left shoulder, we had a head, we had a right shoulder, and then we had, oops, I deleted it by accident. Let's try that again. Excuse me. There we go. We had a violation of our neckline, and lo and behold, right after that violation of the neckline on this candle, we started seeing a move to the downside. So again, not that this was necessarily a selling opportunity for you guys, but a good example of that RSI head and shoulders technique that I taught you in the previous video. So just to recap, no need to rush here, be patient, wait for price action to give you clues for the reversal, but I do think there's an opportunity to trade this higher. If you're enjoying these market breakdowns but want to understand more about what you're watching, I invite you to check out Tier 1 Trading. We have step-by-step trading courses, live trading rooms, private Q&A sessions, and an incredible community of traders, all focused on helping you develop into a consistently profitable trader. Also, I can't spill the beans yet, but we've got some massive upgrades coming to the site that are going to help streamline that process even better than before. So come check us out for a 14-day risk-free trial membership. And if you're serious about becoming a consistently profitable trader, we'd love to work with you. Next up is the Dow, and we have a potential bullish Cypher pattern here. And I must give credit to one of our Tier 1 trading members, Devin, who shot this over on the chat this morning, because if I don't, he will kill me. And this will be the very last Trading Edge video that you guys will see. So thank you, Devin. But let's talk about this bigger and smaller picture. So let's start off by drawing out the Cypher. We have our starting point right here. That's going to be our X leg. This swing low to swing high is going to be our X to A. Step 2 is that I bring on my Fibonacci retracement and I measure it from that same swing low to swing high right there. I drag my mouse out here just so I can have the fib levels kind of extend, but I am anchoring it to this high point right here for you guys that ever wondered why my cursor's out here. Anyway, the B requirement for that Cypher pattern is that we hit the 382, and you can see that we did. Now, this is very important because some people may look at this and say, oh, well, we just hit it, Akil, does that count? Or in maybe other cases, we just missed it, does that count? And this is what I love about black and white rules. There is no does it count or does it not count. It either is or it isn't, right? Price touched the 382, therefore it counts. If it did not touch it, it did not count, right? There's no debate amongst that. So we did hit a 382 right there, which is step 2 for the Cipher. Step 3, we need to see this extend to our 127. That's going to be me taking my Fibonacci extension from that same swing low of X to my swing high of A right there, and seeing that that 127 was hit. And for our D completion, we're going to need price action to come down to our 786 Fibonacci retracement, which I think I drew on accurately because I like to play a game with myself where I draw these things on before putting the fibs on to see how good I am. And I'm a little bit off right there, but I'm close. I'll half credit, right? Anyway, as we put it all together and we label it to make it easier for you guys, we have our X to A, swing low to swing high, A to B, first retracement, B to C, extension higher, and our D completion right down here at our 786 to start the completion zone of our Cipher, which goes all the way down to the bottom of our X leg. Now, what I like about this, and this is my take when it comes to trading versus investing. As a trader, I am technically driven first. I am fundamentally driven second, meaning that as a trader, every decision that I make is based off the technicals. If there are fundamental reasons backing it up, those are always taken secondary, meaning that I cannot enter a trade due to a fundamental reason. But if I am in a trade due to a technical reason and a fundamental reason supports that, then I can do stuff like shoot for bigger targets and all that jazz. In investing, I'm exactly the opposite. All of my decisions are made off of fundamental reasons, and then technicals assist me with pinpointing entries. And this would be a perfect example of this. Let's say you are a Dow bull, meaning you are someone that wants to get long the Dow because that is a smart thing to do to get long an indice over time, right? If we look at our chart on the weekly, what do these things do? They go up, right? So not a bad reason. But you need assistance on understanding when do I pinpoint places and times to get long at? When am I getting involved at the right moment? Well, obviously you can use support and resistance and any other technical key level to do that. But something else you can do is use pattern formations with that. And in this case, you can see that the decompletion zone of our potential Cipher pattern lines up right at the previous outside return, or excuse me, the previous new structure high that price action once made, right? So if you are someone that wants to be involved in the Dow, right? Maybe you're doing like not necessarily a dollar cost averaging, but you're someone that invests on a regular basis once we get a retracement, this is the perfect entry reason to get involved. It's due to your fundamental reason of always being long the Dow, but the technical analysis allows you to wait for, quote unquote, the perfect area to get involved with. So a cool example of how technical analysis can be used in longer term investing and not just in trading. If you're someone that likes Confluence and everything aligning, you're gonna like this one here on the Canada yen. But let's first start off with some price action clues as we work through our normal repetitive IPDE process. So let's go through this together, right? First step, identify. What has price action recently done? Specifically referring to that big green candle. If you said broke and closed above a previous level of structure, then you are correct. The next step is, since we identified us breaking and closing above that previous level of structure, then what are we likely to do next? So what is our directional prediction, bullish or bearish? If you said bullish, you are correct. The next step of our prediction is not just predicting the direction, but predicting the location. So if price action is likely to go bullish, then where are we likely to go bullish to next? And the answer to that question is going to be right up here. Now, I know what you're saying, Akil, that is an extremely big zone. It is almost 100 pips large. Don't worry, we're going to come back and dial down a specific point inside that zone a little bit later. But what this does is just give us the idea that, hey, there is room to go higher, and it tells us whether this is a trade that we should focus our energy on or whether we should click to the next chart. Now, As we go down to a lower time frame, you're going to see a much clearer picture of what has been happening. Price action has been in this bullish trending move. Price action has extended up. We've retraced down, we've extended up, and just like before, it would not surprise me if we retrace down before extending up once again. So this is going to be a pullback trading opportunity where you're looking to buy on the retracement, the relief, and trade it up to whatever zone we're about to analyze. So now let's get to the question. Where in this big old zone is price likely to go to? And we can do a few things here. We're going to start off by using Harmonic Price Action Tool. And essentially that's going to be what's called one-to-one equal moves or AB equals CD patterns. And to do that is pretty easy. What I'm going to do is I'm going to take my line tool. I'm going to anchor it to the bottom of our move right here. So the starting point of our extension higher to the end point right there. And I'm going to copy and paste that. And I'm going to project where price would go to if we saw an equal length move. I'm going to anchor it to the next retracement right down here, I should say. Boom. I'm also going to do the same thing for our most recent move right here. So I'm going to draw a line out just like that. Let me change the color just so we're not confusing everyone. Boom, there we go. And same thing, I'm going to copy and paste that to where we currently are at. And we're going to see, excuse me, there we go, that these moves are going to line up in a very similar location. I'm going to do the same thing, but now with my Fibonacci extension tool, which by the name projects where price is likely to go to if we would extend by using Fibonacci levels. So I'll take my Fibonacci extension tool right here from this first bigger swing low to swing high and back down to the bottom right here. You can see I have a 1618 Fibonacci extension right up there. And I'm going to do the same thing with this one, Fibonacci extension from our swing low to our swing high and back down there. And I got a 1618 extension here as well. So if you check this out, right in this zone, I've got a 1618 Fibonacci extension from the bigger swing. I've got a 1618 Fibonacci extension from the smaller swing. And I've got both AB equals CD patterns essentially right at the zone. The big one's a little bit higher, but we know things aren't always exact when it comes to price action. So what I've done is I've taken that big almost 100 pip zone and I've now dialed down on what? A little zone of about 15 pips. So a much better target projection there. And you can see it lies right at the top. If I drag this to the left and I don't mess it up here. Oh, I messed it up. Sorry about that, guys. Right at the same area that I would highlight if I were projecting this zone from the lower time frame anyway. So a good idea there to look for a pullback trade. I think we could expand up to about 117.20. And if you're being a little bit more cautious, you can always shoot for that 117 even handled number, which is a psychological level as well. So here on the Aussie Yen, we're going to do something a little bit different as we're going to dive into a more creative way of thinking about entering the market. And this stems from a question that we often discuss over at Tier 1 Trading, where our traders will ask, hey, are there alternative ways or methods that I can take to enter advanced pattern formations? Specifically referring to the Cypher pattern since it typically doesn't have the greatest risk reward. So let's start off by measuring the pattern and then we'll dive into kind of an alternative way that you can take a look at if you want to test it out. So we have our Cypher pattern starting as always with our swing high to swing low, our X to A leg, our retracement back up being our A to B, our extension to the downside being our B to C, and then our move back up to the 786, which I believe was right about there, as being our CD completions. Let me just get this on once again, A to B or X to A to B, B to C, and then our CD completion, a little bit off there, right up here. So you can see this Cypher pattern has already completed, with the zone going from our 786 all the way up to our X leg. So when I say the zone of completion, it means that once we reach that 786 Fibonacci retracement, that is where the Cypher pattern is officially completed. If we were to close or break or close above the X leg, then the Cypher pattern would be invalidated. So in many cases, when you're trading advanced pattern formations, you will enter on an aggressive limit order right at the beginning of that completion point. But an alternative way of getting involved is waiting for price action to get into that completion zone and then looking for a reason for entry. Now, One of the downsides of waiting for a price action reason for entry, for example, like a lower low, lower close, is that by the time you get a lower low, lower close, well, that may happen way outside of your zone and you may end up with a much worse risk reward and you may end up just in the pattern formation really, really late. So if you're someone that's looking for maybe a quicker way to get involved, let's go back to our RSI, right? In the previous RSI video, I shared with you that really weird, strange method of how one of my best trading friends taught me how to use the RSI without even looking at a price chart, which was crazy and mad until he actually did it and it started to make sense. But let's look at this example of that case. As the price action is making a bullish move, as we came from our C leg up to our D leg, the RSI should be doing the same thing, right? This RSI should be replicating what price does. So if we take a look at the most recent moves on our RSI, let's see what we have here, right? We have a low right there. We have a high right here. We have a higher low right there. We have a higher high right there. We have a lower high, or excuse me, a higher low right there. And we have another higher high right here. All the things that we would expect in a bullish move. Now, what if the RSI violated our previous low? Well, if we were looking at this in the sense of this being a price chart, we would say that once the previous low is violated, that would be a termination of the bullish trend, and we would put ourselves in what's called a bearish rotation. Doesn't necessarily mean a bearish trend, but it's the first sign that a trend is likely to reverse. So if you're someone that's looking for maybe an alternative way to enter this Cipher pattern, but you're not necessarily waiting for an entire, reversal of that trend because that would be too late, maybe you can track something on the RSI like this, where if price action does violate the previous low of the RSI, then on the close of that candle, that is your signal to enter, and then boom, you can get involved. Again, not saying that this is something that works. I've never tested it, especially with the Cipher pattern, but we often say that the best traders are creative, and this would be a very creative way to combine your indicator and your advanced pattern formation into finding an alternative way of getting involved. Worth a try. I was going to do the same thing with the ADX as well, and I know this indicator is not as common as the RSI, so for the weekend video, we'll just let this be. But yeah, there's something for you to play around with this weekend. The dollar Canada has been somewhat of a wacky pair as it's been sandwiched between tariff news and war news and oil news, and well, it doesn't really know what to do right now. So it's no surprise that we're seeing it really just pause and have a think in the middle of this last retracement. Just to catch you up, the most recent move we had here on dollar Canada was a break and close above the highs here. We ran into a previous level of structure looking left. The market had a think and pretty much dropped off a cliff to the downside before starting to retrace a little bit throughout the week. As we go down to a lower time frame, you can see we're stuck like Chuck right in the middle of this zone. And the question as traders that we have for the market is, okay, what is likely to happen next? Now, the cool thing about that is I don't actually need to answer this question. Rather, I can wait for price action to answer it for me. These are my favorite trading situations to trade, where the market is just consolidating and eventually will break out. And my job as a trader is to wait for that breakout to happen and then react accordingly. So if we break out to the upside, the question I want to ask myself is, where are we likely to go next? And the level that stands out to me is going to be this bottom area of structure right here. If I bring some volume on, hopefully that gives me some confirmation. Yep, you can see that right above about 141.60 is where our volume starts to spike up. That's pretty much in line with where price action retraced to multiple times back in the day, for lack of a better term. So if we can break and close above these highs right here, I would expect price to travel back up to our upside here. Now, vice versa, if we were to break to the downside, well, this one's a little bit easier, right? We have a clear structure low right here we can shoot for, but I do think there is more room to go to the downside as well, just as part of that bigger picture. So if I just go back to the daily for a second here and we take a look at our last swing, there are a few things I can do to really kind of generate a zone of interest. One, I want to take a look at my most recent levels of structure. And the thing that stands out to me are going to be these two little humps right in the middle, the one from back in January and then the one from back in April. And I'm just going to drag this zone right across the middle here to kind of give us a visual representation. The next thing I could do after that is I can take my Fibonacci extension tool from the swing high of this most recent move right up here to the swing low down here and back up. And that's going to give me some pretty good Fibonacci levels. The two that stand out to me are going to be the 127 and the 1618. The other ones are on there for different strategies that I use. Now, I want to do one more thing as well here. I want to take a Fibonacci inversion of this latest retracement. So I'm going to take my Fibonacci extension tool again, but this time draw it backwards from this swing high to this swing low right here and back up. And I just want to see, yep, look at that. I have a 1618 inversion lining up right with that 127 extension. And that's going to come right at the upper zone of this inside level of structure. So I do think that's a good level to shoot for. It's also right above the 139 even handle, which is a psychological number. So if we are looking for a move to the downside, not only can we expect a move back down to retest these lows, but you can probably get a little bit more off of it as well and expect an extension right back down to 139.35s. Here in the New Zealand yen, we're going to have a perfect example of how yes, it's important to understand specific patterns and specific setups in the market, but why it's more important to have a true understanding of how price moves and more specifically what it means when it does certain things. And I'll explain that in a little bit. But you can see what recently happened here on the New Zealand yen is that price came up to retest a previous structure high. This is a level of resistance right here. We had a nice V reversal. We came down, had another V reversal, and we came right back up to the top. And here at the top, we put in a very interesting symbol or signal, I guess you can say. We had a very long wicked candle to the upside. Now, despite this being a green candle, which is technically bullish, just like the one before it, what's interesting is that because of that wick to the upside, it shows us rejection at that level, meaning that at one point the bulls pushed up and then the bears took control and pushed it back down. And despite still closing higher than the open, this is certainly a sign of indecision or in some cases a bearish move. Now, what's important is what happened after that, and that's where we're going to go down to a lower time frame. Now, as we head down to the lower time frame, the 4-hour chart, I can already hear many of our tier 1 trading members saying, Akil, isn't that a head and shoulders pattern? I can also hear a whole bunch of other members saying, Akil, in no way do I see a head and shoulders pattern. This is a debate that we have on a regular basis within the live room. What I'm here to tell you is that it doesn't matter whether it's a head and shoulders or not, because all that matters is understanding, was the key level violated or not? And the key level that I'm speaking of is going to be this low right here, because taking out these lows is going to confirm our potential bearish move. And you can see that we achieved it right there. So whether it's a head and shoulders pattern and you see that as a violation of the neckline, or whether you're just a price action trader and you see that as a violation of previous structure, it means the exact same thing. A violation of structure, in this case a lower low, lower close, allows us to predict that price is likely to continue lower. So what are we waiting for next? Well, if you're not a breakout trader, you are then waiting for a pullback, and that's exactly where price came to right here. Now, I'm recording this on a Friday. I do not think it's a great idea to enter a trade on a Friday afternoon. The markets aren't going to move at all. Then you got to deal with the whole weekend gaps and all that fun stuff. But if price action gives you an opportunity as we open up the next week, I think this is a perfect opportunity to get involved for a short and to try to catch that next extension down. Now, to answer the question of if price extends down, where are we likely to go to? A few levels that stand out to me are going to be this. It's going to be this zone right in here, specifically looking at this inside level of structure there, this inside level of structure there, and then our most recent inside level of structure there. And in order to get a truer read on this, I'm just going to bring in some volume from my swing high to my swing low. So I'm taking this entire range and seeing if any one place stands out. And you can see that it does. If you're new to volume, I highly recommend checking out the video I did on using the volume profile tool. It's something that I added to my trading, 3 years ago now, and it has been a game changer after about a decade of saying, I hate volume, right? This is the beauty of a growth mindset and being open-minded and also being able to talk to some of the smartest individuals in this industry. But essentially how I use it is like this. I look at volume levels as being synonymous with interest, the same way I look at support and resistance levels as being synonymous with interest. So therefore, the key levels of support and resistance should be backed up with high levels of volume. And the levels that have the higher spikes are going to be the levels that I deem to be more important. So you can see we have a high volume spike right here. We also have a high volume spike right there. And once again, this allows me to take this big zone, which is, I don't know how many pips large. I don't feel like measuring it, but I guess I will because I'm talking about 100 pips large, and really narrow it down to this small zone right here, right? And again, we have this void of volume, which I would expect price to slice through like a hot knife through butter. So looking for a move down to 93.50s is certainly something that is doable. The Australian dollar has once again been one of the strongest currency pairs of the week, and this is opening up a really big potential move to the downside here on the pound Aussie. Now, if we take a look at what has recently happened before we get into what I think is going to happen next, you can see that price action recently ran into a previous level of structure looking left, and we fought this level 1, 2, 3, 4 times before dropping off to the downside. And if we go down to the 4-hour time frame and take a deeper look at this, you can actually see the rotation that trend put in. Price action started rallying up. We had a little bit of a retracement right here, a little choppiness before putting in a new structure high right here. We then had a retracement and then put in a new structure high right there. Price action then ran into that previous level of resistance. We went sideways for a little bit here, right, with one final push up to this level. And then we finally put in this move right here, which broke and closed beyond our technical previous outside return. Now, if you're not familiar with how to read a price chart and the specific rules that I'm referring to when I say stuff like new structure high and outside returns, I'll put a link in the description box below for a free training video that I did on YouTube that will teach you all of that. But essentially what that means is that once we had this most recent move, that technically invalidated our bullish trend and put us in a rotation for a bearish trend. Now, with that being said, it doesn't mean that we have a confirmed bearish trend. What we need to have a confirmed bearish trend is one more violation, and that violation has happened right here. Now, I know it doesn't seem like much, but if we dig into the details and look at the low of this candle right here, we can see our low is 19063. And if we dig into the details and look at the low of this candle right here, the lowest close of this candle, I should say, we're going to see that lowest close is 19062. So I operate on black and white rules. There's no gray area. That's the way I stay objective in the market. We technically had a lower low, lower close right here, which confirms that bearish trend. I guess technically this line should be something like that. But you guys get what I'm doing, right? Anyway, all this to be said, I'm expecting a bearish continuation. Now, with that being said, we'll either need a bigger retracement, or I'd love to see just a little bit of a push lower first and then another retracement to get involved. But what I would expect is a continued move lower. And in order to determine where that continued move lower could go, there are a few things I can do. Let's start off by bringing in some Fibonacci's. I'll take my Fibonacci extension tool from the most recent swing high to the swing low right in here. Yep, and back up. It's going to give me a few levels. I'm going to have a 127 extension right below that 190 even handle. I'm going to have a 1618 extension right below that 189 even handle. Let's bring in some volume as well. We'll just take it from this full range, our swing low right here, to our swing high. And you can see that although we have a couple volume spikes, we honestly don't have a big volume spike until we get all the way to the bottom here. So for you guys that are aggressive, you can certainly shoot for a move all the way to the bottom. If not, I would target this 190 level as my first conservative target and this 189 level as my second conservative target. So potential shorts here on pound Aussie. Keep an eye out on this for the week ahead. The dollar yen has been an interesting pair this week because despite all the fundamental fears about more yen intervention, we're actually continuing to see bullish actions on this pair as we just broke out to the upside from this wedge pattern. And what we have on the radar for today is going to be two opportunities, both a buying opportunity and a selling opportunity. Now, the first thing we need to do is we need to perform our technical analysis and go through that IPDE process, identify, predict, decide, execute, and ask ourselves the question, where is price likely to go to next? And in order to answer that question, we need to go to a higher time frame and see where the next level of structure is at on the weekly. Now, I'm going to have to scroll back a long time here, right before many of you were born. But if we look back here in the year of 1987, this is going to be our next level of outside structure. And I know 1987 is a very long time ago, but chart don't lie. That is the next level of unviolated structure that we have. Therefore, it is the next important level that the market should be paying attention to. And you can see that level is going to come right around 164.40s, 164.50s, around that area. Now, as you go back down to the daily, you can see that we have an interesting setup happening as we end our week. We had a very high momentum, strong bullish candle form on Thursday. And so far today on Friday, we're putting in a smaller ranged indecision candle, right? This is going to be an inside bar. You can see that it completes the current bar, the red one, completes completely within the previous bar. And what that means is consolidation. It means contraction. It means a range is forming on the lower time frame. And as we hop down to the 4-hour, we'll see exactly that. Now, this formation is going to be called a high and tight flag formation. And when it comes to flag patterns, there's three ways to trade this. There's the before, the during, and the after. And we'll focus on two of them for today's session. The before would mean positioning yourself in a buying opportunity before the flag pattern breaks out. Now, what's cool about this is that it's going to give you the best risk reward, most likely, because you're involved at the very bottom and you're looking to get out at the very top, and the risk reward is beautiful. However, the problem is that it's not going to provide you any safety. It's a little bit more risky because you do not have confirmation that the break is likely to happen. The second way of getting involved would be the after, and that would mean waiting for the confirmed breakout, so a higher high, higher close above the upper range of this flag pattern, and then looking for the pullback and then looking for your chance to get involved that way. This way does give you a little bit of safety because you have confirmation of the breakout before positioning yourself long, but I guess the risk in this sense is that, well, maybe we get a move just like we had right here where, oops, sorry about that. We get a move just like we had right here where the market breaks out and just never looks back. You don't have any opportunity to get involved in the trade. So understand there's a give and a take, a pro and a con to everything. There is no best entry. There's only the entry that works best for you. So that is one way to look at it if you're looking for a long position. For those looking for shorts, there's a pretty cool opportunity setting up on the weekly. We're going to have a harmonic pattern in the form of a butterfly pattern. I'm going to measure it out in two different ways for you. And if you're unfamiliar with the butterfly pattern, I call it an exhaustion pattern because what we're looking for in the butterfly pattern is for price to put in a clear directional move, in this case to the upside, and then we're looking for the buying pressure to slow down and the selling pressure to increase. And just like any other pattern formation, our butterfly pattern starts off with an impulse or an anchor leg. It's going to be a clear directional swing, in this case a swing high to swing low. We then have our next retracement up here. And what we're going to do is we're going to take our Fibonacci retracement tool from the high of that swing to the low of that initial swing. And we're going to see what Fibonacci retracement level that swing comes to. Depending on what Fibonacci level is hit, that's how we know what pattern to qualify it as. This one you can see comes to the 786, which puts us on alert for a butterfly pattern. We then get another retracement down, which doesn't violate our A leg here. And what we're looking for next is where our D completion is going to complete. Now, depending on how you trade the butterfly, you're going to have different zones for the completion. And I'll draw two of the most popular ones. The one I personally like to use is a Fibonacci inversion. So I want to take my Fibonacci extension tool from the swing low of my A back to the swing high of my X and back down. You can see I'm going to look for that. Oops, 127. There we go. Fibonacci inversion right here around 168.10. I'll just put a little mark right there. Another way is taking your Fibonacci extension tool and dragging it from your A leg to your B leg right here and back down. And what you'd be looking for is that 127 Fibonacci extension. You can see these are going to give you two drastically different results. So it's very important that you understand which one you want to trade. The point is, as we reach these zones, either the short zone or the tall zone, these are areas where that butterfly pattern would complete, and that's where I would expect levels of exhaustion to start affecting the market. Now, just to touch on the intervention thing, because I know it's really scary to be thinking about getting long the yen. Now, understand that we've been dealing with these yen threats for a while now, and in this calendar year, we only really saw one intervention, and honestly, it was pretty short-lived. And I don't think the Ministry of Finance is going to swing and miss again unless they're in a situation where they're going to have the backing by the traders, the investors, right? So they wouldn't do it unless there is something happening in the market that is prompting traders to buy the yen anyway. For example, like an interest rate hike. Now, Bank of Japan does have an interest rate hike coming out next July 31st, whenever that is. As of recording this right now, I don't believe there are any plans of hiking rates. I think they're going to keep them steady, but that would be something to be aware of. If the mood does change to, hey, Bank of Japan is going to hike interest rates at the next meeting, that could be the perfect excuse to tag team with the intervention. And that's when I would have much more concerns about being long. And you probably have much more profit potential if you are in a short position on the yen. So just keep that in mind as the week flows ahead. So this week on the New Zealand dollar, we're pretty much just going to follow up on what we spoke about last week. Last week, we talked about a potential head and shoulders forming. This week, we did get a bearish pullback forming our right shoulder. And well, all we need next is the violation of the neckline. Let me draw this on for you one more time in case you weren't here last week. But our swing high to swing low right here starts our left shoulder. We then extend down for the head. We have a deep retracement back up right here. And then this retracement right here that we did this week, that's going to be our right shoulder. Once again, in order to have a validated head and shoulders pattern, we need to violate the neckline. If you're using a slanted neckline, that's going to be this dotted line right here. If you're using a horizontal neckline, then I would look for the high right here to be violated. Now, I told our traders this during the week. One thing I would pay attention to with the horizontal neckline is if you look left, you can see these little spikes right up here. I would just advance this point a little bit higher to clear that level. That's going to give us a much better sign of a bullish continuation versus that lower level. And I know it's something that's very, very slight and small, but trust me, these are the things that make a difference in trading. So if price action can violate this level, expect a bullish continuation right back up to the highs here on the New Zealand dollar. So when we last took a look at Bitcoin, we were looking for a potential head and shoulders pattern as price dove down into a previous level of structure and just kind of started to die out. A head and shoulders pattern is a classic reversal pattern. So if we were going to see a reversal at that area, well, a head and shoulders pattern would be a likely price action pattern that we may see. Now, we started off well, and this was a few weeks ago. I think we looked at this in the trading edge with our left shoulder down here and then our head down here. And at the time, we were looking for our right shoulder to form. And I honestly can't really say that we got that. You may see it here and then here, or you may be seeing this as a test of the neckline right here, and then maybe the right shoulder coming in next. That's probably the most likely scenarios we do something like that. But again, it doesn't really matter whether this is a head and shoulders or not. What matters is we violate the key violation point. And for me, that is going to be these highs right here. So if price can take out these highs on Bitcoin, then I would expect for price to continue higher. With that being said, I see no reason to jump the gun, right? If we look back at what price action has done in the past, we consolidated down to this level for a very long time. And again, it would not surprise me if we did that here as well. So as traders, we always want to be predictive in our analysis, reactive in our execution, meaning that we want to predict what could happen, but then we want to wait for price action to give us a clue that it most likely will happen. And for me, it's going to be a higher high, higher close above that solid black line. So if we get that, we can start projecting a move higher, either via breakout or pullback and extension. But until we get that, I would certainly keep my powder dry because well, there's just no reason to waste money in the market without a clear reason for trading. Well, you made it to the end of the video, so clearly you enjoyed it. Just don't forget to let me know by hitting that like and that hype button before you go. Also, check out this playlist if you're wondering what you should be watching next. Until next time, plan your trade, trade your plan. Take care.